Hey everyone, welcome to CoveredCall ETF Investing, and today's video is all about trying to figure out what is the best yield or yield range for you based on where you are in your investing journey. Are you someone who is building wealth for the long haul, or are you someone who is living off of your wealth? And we want to try to help make sure that you don't migrate into certain strategies that really are not appropriate for your goals. So that's also a self-checkup as well, is understanding your goals, knowing what the destination for your money is. It's not just important for being motivated and staying invested, but just to help you stay on course. So I'll give my how I look at this, how I think about yield, my own strategy as an example. We'll get inside the CoveredCall ETF All-Star Tracker to look at a batch of diversified funds across different yield ranges, which, by the way, running a big sale right now here in January of 2024, $50 for a one-year membership. So you get 12 trackers in all of 2025, plus definitely some bonus goodies throughout the year as well. So anyway, there will be links in the description below that will give you instructions to get you that tracker. We'll also look at a fund that it might sound like heresy for many of you, but we'll look at what you could consider a NAV decay strategy, a NAV erosion strategy, grinding the NAV strategy that actually might make sense. So, depending on what you think of my hypothesis on that, you can certainly light me up in the comment section for that. So let's start with the wealth building aspect of investing. So I'm 35. So if you are on the 10 to 15 years on either side of that, you are probably in the what's known as the accumulation phase of your investing journey. And simply put, this is you just buying shares, buying units of ETFs. You are buying more shares so you can compound the income, the dividends that are going to be reinvested, give you much bigger lion's share of the share price appreciation. But it's the name of the game really is about just compounding. So most of us, right, that's a pretty easy way to think about that. And so as an income investor, what makes sense to build wealth if you are in this phase more naturally? Now, maybe you don't care about that and it's just all about just the highest yield and everything else doesn't matter. I suspect, though, that the vast majority of you still want to grow your wealth over time, and it's not just simply about just getting the highest dividend possible with no aim whatsoever. So there's probably two ways you can go about this. You can go for a bit of a split strategy between growth and yield. So in my case, that's where I'm at. I'm trying to look for the maximum price growth mixed in with what is the maximum distribution or yield that I can possibly get with my investments. And so far, what I'm finding in my 3 years of investing for income is that 10 to 12% seems to be that magic range I'm finding for myself. That helped me beat all the markets last year in 2025 with a diversified fund of all-in-ones, ETFs that invest in other ETFs to really help get there. Now, some of the benefits of investing for a little bit of growth, runaway unrealized gains is like a good problem to have. It certainly gives you options, but that's not ideally what I'm going for. I always want my money working for me, any income that is generated. And so I don't want this runaway greenhouse effect when it comes to unrealized gains. But you get flexibility there if it does do that, which it happened to me with HTAE. I had held it for a year. It racked up a lot of unrealized gains. I wanted to put that money to work, ended up switching that out for QQQY. You just get more of your distribution through, or you get more of your return through the distribution versus through unrealized gains that just aren't, that's kind of like dead money. It's just not doing anything for you. So that is a good problem to have, certainly. Some other benefits of a strategy like this is if the markets take a bit of a dip, you could at least be confident that there is enough flex in the strategy that it can grow back over time. Covered calls naturally have a drag on price. They cap upside. But if you invest in certain funds that the call option writing is fairly moderate, right? 30 to 50%, that other 50 to 70% in the portfolio can just naturally grow and do whatever the underlying index is doing or the underlying funds are doing. So this might be the S&P 500. You're into a bunch of funds that track that or track the NASDAQ 100. Much more American focus, which is something my TFSA is basically solely dedicated to. Maximum growth potential, which is basically the US. It's not 100% American in my TFSA, but it's basically it's like 75%, I would say at this point, maybe even approaching 80. Okay, so it gives you much more opportunities to grow back if you've taken a shock. Now, the other good side of it is if we find ourselves in a bull market, even just 1 year, like say 2024, there's a good chance that the fund managers might raise their distributions, naturally growing your income. And last year, basically all the funds I held got a natural boost. BMAX got, I believe, 2, HDIV got 1, HDIV got a couple, HYLD got a couple. When HTAE was in my TFSA, that got 1 as well. And it all got a nice boost. And what a great mental win it is to see your income grow naturally like that, where you don't have to work extra hours or you don't have to, pull from somewhere else to contribute just to make more. Now, for the most part, you are going to be doing that, but this is just a nice bonus that these funds can provide on the upside of things. Give you a little bit of price appreciation, give you some flexibility if you need to sell off, maybe switch into something else, especially as you're coming to kind of learn and understand your own your own tolerances with income investing. So that's the split income growth kind of together. And honestly, it's not a bad thing. It's if you're an income investor, you're investing in covered call ETFs, it's like, man, embrace the little bit of growth that can come from that. Right? As income investors, again, I can't stress that enough. It is not a bad thing to put an aspect of growth in your portfolio. And most of us want that anyway, whether you say it or not. The reality is we want our portfolios to grow. So give your portfolio opportunities wherever you can and just do it responsibly. But some of that just comes with experience. And stay tuned to this channel, watch other channels when it comes to finance, and really just stick with the language of finance to cultivate that interest. So this stuff can eventually become a little bit more second nature, and it comes to you a lot easier. Because trust me, a lot of this stuff never made sense to me. I just stuck with it. Even when I never understood, I just stuck with it. And guess what? Over time, it comes, and it will come. And I'm like, I don't think of myself as someone with as being gifted with this stuff. It's just it just has come with time. That's all it really has been. So part number 2 when it comes to accumulation phase is going for more of a yield strategy. Yield. You're a yield hunter, yield hog. You don't really care about, and maybe you despise price growth. It's a wart on your heel, so to speak. So you could do it this way. I believe it to be a little bit harder, and I think with the other way, you'll sleep a little bit easier at night. I think there's a much better chance at just sticking with it throughout the years. But the one thing with this strategy, what it does do is, unlike the price appreciation side of things, all of your return is coming through that distribution, which means in that case, if it's all coming through the distribution, that means all that money is working for you, no matter what. It's on drip, it's working for you nonstop, no matter what. There is no sort of split, right? But the downside is that we pretty much need a never-ending growing market for these styles of funds to keep up, or at least to maintain their just overall net asset value, which I don't believe that's not going to be the case. You never know when there's going to be prolonged periods of down markets. And I mean, if you even look in the 2000s, from 2000 to what, to like 2011, right? It took whatever the peak was at the dot-com bubble all the way to, after the financial crisis of 2008, probably took in the range of 10 to 12 years before you got back to where you were before at the height of dot-com. So you just never know. And that might discourage many of you who are investing solely for just yield and just for income without that little bit of help from the share price. So you could go that way. There are, of course, nice things with just getting your money working for you right away. But I do believe that for the vast majority of us who don't necessarily want to go into the thick and the weeds of this stuff every single day, this actually might be the best way for you. So now that we've talked about the accumulation phase, whether you go for a split income growth style strategy, or you have a strategy that is much more higher yielding, income focus, and compounding that total return, more of the distribution coming through just the premiums that are generated from the cover calls, we will also want to discuss what's the next phase is the decumulation phase. In this stage, growth isn't really maybe all that important anymore. Now, maybe maintaining wealth is. It could be. So this is if you're in a range of you're close to retirement, you are retired. Now you're asking maybe different investing questions that can help get you to a certain lifestyle that maybe you've wanted after your working years. Now in this, there are potentially higher yielding products that you might be able to get into if you're not necessarily worried about, maintaining well to pass on to somebody. It's really just about, I want to live out the rest of my life, and maybe whatever money's left, it actually doesn't matter as much. Certainly a million different scenarios here that you could potentially consider. But naturally in this phase, you could still do the split growth, like any one of these phases. You really could. I think it's a little bit more detrimental if you're in the accumulation phase, going for strategies that aren't designed for growth, or they're really not designed for growth. And we are going to look at a fund that is specifically like that in a little bit here. But anyway, this is really to just say that in this phase, there are going to be funds that we're going to look at that really could be right for you. That might be surprising even for me to talk about, just because I'm much more oriented towards, again, that sort of growth and yield style of strategy more so. But again, in this phase, you might be getting into funds that just help maintain your wealth, or at least start winding it down. And certain higher yielding products actually might not be that bad of a thing for you, especially if the intention is to track these investments a little bit lower. I think if you're in the decumulation stage as an income investor, I think it's less detrimental to invest in, say, the half growth, half income approach, or you do invest in a fund that really isn't about growth at all. It's just about, maybe it's higher yielding. Maybe it maintains a bit, but it's about taking those investments a little bit lower. it's probably less detrimental for the person in that stage to invest in pretty much everything than it is for the person in the accumulation stage going to the fund that has the high yield, but really it won't have the same long-term growth effects, not just on the price side of things, but even potentially compounding the income generated from it. It might not have the fruits that you're looking for. So now that we've kind of discussed a little bit of what you can expect on the decumulation side of things, of course, we've spoken a lot about the accumulation side of things. Let's look at a fund that is designed for those potentially in the decumulation phase. So many of you are quite familiar with Roundhill Investments. They are responsible for popular American funds like XDT, QDT, RDTE, but they also have this other fund. It's not a cover call fund, and it's called XPAY, the S&P 500 Target 20 Managed Distribution. And to really sum this whole thing up, this fund is quite literally a NAV decay strategy, a NAV erosion strategy, a grinding the NAV strategy. It's meant to wind down your investments, especially if you're someone who's maybe invested in the S&P 500 your whole life. You don't really want to get away from that. This is a way of still having total exposure to the S&P 500's growth, but it's giving you a distribution rate of 20%. It is designed to get it to be fully return of capital. That's what this overview really talks about. As it shows here, tax efficient, XPAY seeks to target 100% return of capital distributions. It seeks to match the total return of the S&P 500, and XPAY seeks to offer consistent and predictable monthly distribution payments to shareholders at a rate of 20% annualized. Like that, there really isn't anything you can criticize about a fund like this. It is so clearly and obviously a kind of strategy for those who are looking to maybe still have exposure to the S&P 500's growth, but overall you're okay with it with an annualized distribution rate of 20%. This is a pretty interesting structure of a fund. The one thing I would say, or my one criticism about a fund like this, is if you're going to get into something like this and you're older, I would say, and again, winding down investments, that's the stage you're in, why not throw a cover call overlay on that and not just simply have exposure to the growth? If this is truly about, winding down, I mean, maybe make a little bit extra on the way down, but again, I guess the only drawback with that is, at least with XPAY, you still get exposure to 100% of the growth, whereas you throw a cover call overlay on it, you don't have that anymore. Okay, so now that we've discussed that, let's go to the All-Star Tracker and look at a batch of diversified funds that are all-in-ones, ETFs that invest in all and other ETFs. I also have a mix of index funds in here that are cover call based, like QQCL, USCL, ETSX, and ESPX. And what do you notice about these funds? Well, they all are kind of in this kind of close band of yield together. You don't have these wildly different kinds of yields with these funds. You know what I'm actually going to do? I'm going to move this actually over here so that we can actually see what the average yield is for all of these funds combined together. So you get about, if you were to own all this equal weight, you would have about a 10.65% yield currently. Let's even just look at performance. What do we, if you held, say, all of these funds, what would you get? What would your price performance be over the course of 1 year? Well, price performance wise, 11.69%. That's better than the average return of the S&P 500 over the last basically forever. But yeah, anyway, that's not going to be every year, but it just goes to show you a cover call fund that can actually put a lot of growth behind it on that side of things. But then you put in the total return. So on average, you get about 11.69% there over the last year. Total return wise, you get, if you held this all equal weight, 24.34%. Obviously, if you consolidate these funds, you can even make that certainly a little bit higher, right? Imagine if you only owned QQCL over the past year, its total return is 36.96%. Maybe you mix that in with a couple, maybe you do the top four, HYLD all the way down to USCL. And what would your average total return be? 29.74%. Naturally, if we consolidate, constrict, and concentrate down into just a couple of funds, you get a much higher chance of outperforming more broad diversification in that regard. So these funds can act as core positions. For me, that's basically all I invest in is core positions. I have HYLD, I have HDIF, I have BMAX. You know what I forgot to include in here? ZQCL. My apologies, but I'm not going to add that in right now. And anyway, so it's in this range that I had talked about at the top of the video, 10 to 12%. And you can see the proof is in the spreadsheet that you can get some awesome total return and you can get some awesome share price as well. So the next batch of funds we want to look at. So this again would work really well. Honestly, it can work really well no matter the stage you're in. Accumulation, decumulation, or at least you want to just maintain, maybe still grow, pass on your wealth to the next generation, whatever. Like this strategy can work well across pretty much all the different age ranges that you might be in, much more so than the opposite way around. These yields, of course, they're on their American side of things. These managers love to jack up yields much more so than on the Canadian side of things. So these yields might attract potentially an older older investors, maybe. Now, again, not guaranteed on that end of things, but hear me out on my reasoning on this, why it could potentially attract an older audience and or older investors. Yeah, and the main reason for this is that these funds, again, they're not as concerned with price appreciation overall. You also don't need as much money to get a kind of return that maybe you thought you did, investing in sort of just regular high dividend ETFs or stocks. So with these, you can use less capital to maybe retire earlier and start winding it down. But certainly maintaining, I would think is for most of us is a big interest. So what do we get for kind of performance over the last year? So these funds aren't even a year old yet, so we don't even get to see what the sort of long term is. But we could certainly look at, say, the last 6 months there so, and right, so not bad. Their price appreciation a little bit down. Certainly over the last month or so, if you're watching this video in January 2025. It's been a bit of a rocky month, so everything's kind of just down right now. And the fund I wanted to even highlight even more so than the other ones is this Defiance ETF, SPYT. It has this target 20%, just like XPAY, but you're going to get a yield of basically the same kind of yield. You're going to be generating more cash flow through those premiums that are generated. So again, I just wanted to show that example as again, you're going to wind your investments down. Why not make a little bit of extra cash on the way down? So overall, hopefully this video helped out. If you have any questions, throw it in the comments below. I'll respond there. And as always, hit all the buttons of the like and subscribe variety, and I'll see you all in the next video.